What if I told you that the most valuable asset in a $10 million retail portfolio isn't actually the building you own?
Right.
Like, it's not the tenants paying you rent or even the land the structure sits on. What if the real gold mine is, the grocery store across the street that you have absolutely zero ownership of?
Yeah, that is the ultimate paradox of commercial real estate. I mean, you are constantly monetizing the gravity generated by other businesses.
It's wild. But welcome to today's deep dive. If you've ever driven past a standalone paint store or a bustling corner strip mall and just wondered how the money actually works behind the scenes, well, today is for you.
Exactly, because you aren't just looking at brick and mortar, you're looking at a living, breathing map of the Texas economy.
And to decode that map, our guide today is a really highly curated commercial real estate newsletter from the Eureka Business Group, or EBG.
Right.
Specifically, we're looking at their listings of the week from April 4th, 2026. And this focuses heavily on the Dallas-Fort Worth and Houston areas.
Yeah, and just to set the stage here, Eureka Business Group, they've been operating since 2008.
Okay.
They function as a full-service commercial real estate brokerage, and their primary focus is really guiding retail investors, franchisees, and business owners through, the mechanics of this exact Texas market.
Which is complex.
Extremely. So when their managing principal curates this specific list, he's effectively isolating the signal from the noise. He's presenting three very distinct avenues for capital allocation that are just hiding in plain sight among the drive-throughs and retail center.
Okay, so let's unpack this. The first avenue, it feels like the most conservative play, right?
Oh, absolutely.
It's a category of real estate that behaves way more like a financial instrument than an actual physical building.
Yeah, you're referring to the single-tenant, absolute NNN properties.
Yeah.
The triple net lease.
Right. And the EBG list has a very specific collection of these. Like down in Alvin, Texas, which is a growing Houston submarket, there's a Jack in the Box.
A classic example.
Yeah, it's a compact 1,650 square foot footprint listed for under $2 million. And they're heavily promoting a corporate guarantee.
Right.
And then over in Abilene, there's a Strickland Brothers 10-minute oil change, listed as absolute NNN with zero landlord responsibility. And that's for a franchise with over 250 locations.
Yeah.
Plus, the newsletter highlights a Sherwin-Williams in Keller, an Outback Steakhouse in Burleson, and a McAllister's Deli in Live Oak.
And the mechanism behind all of those listings is identical. When you acquire that Sherwin-Williams or that Outback, your exposure to the physical structure is, well, it's minimal.
How so?
Because the triple net structure means the tenant is legally obligated to pay the property taxes, the building insurance, and literally all maintenance costs.
Wow, all of it.
All of it. If the roof caves in or the HVAC system fails in the middle of a Texas summer, the corporate entity occupying the space writes the check, not the landlord.
Okay, that sounds like a pure dividend stock. Or like a self-driving car. You just buy the asset, put the keys in the ignition, and the massive corporate tenant handles all the steering.
It's a great way to put it.
But wait, if the corporate tenant is paying for the insurance, the taxes, every single repair, why do they even need a landlord?
That's the logical next question.
Right. Why doesn't Jack in the Box or Sherwin-Williams just buy the dirt themselves and cut out the middleman?
It all comes down to the opportunity cost of capital. Let's look at the burger chain. Say Jack in the Box has $2 million in cash. They have to decide where that money generates the absolute highest yield. If they buy the physical dirt and the building, that real estate might appreciate at, 5 to 8% a year.
Which isn't bad.
It's not bad. But if they deploy that exact same $2 million into their core business operations, like developing new menu items, running national marketing campaigns, or optimizing their supply chain, they might generate a 20 or 30% return on that capital.
Oh, I see. So they deliberately keep their capital out of the real estate so they can just pump it into selling more burgers?
Precisely. They utilize a sale-leaseback model, or they just sign a long-term lease with an investor because tying up capital in concrete and asphalt is just inefficient for a retail operation.
That makes total sense.
And for you, the investor, the dynamic is flipped. You have the capital, and you want a predictable bond-like yield without having to learn how to run a fast food franchise.
Right. I don't want to manage a deep fryer.
Exactly. You are essentially buying the creditworthiness of a national corporation. The building just happens to be the collateral.
That shifts the perspective entirely. Like, the Sherwin-Williams in Keller sits on a road with over 41,000 vehicles passing by every day. But you aren't really relying on local foot traffic to secure your rent.
Not at all.
You're relying on the balance sheet of the Sherwin-Williams parent company.
Hmm.
So the risk is incredibly insulated.
It is. The trade-off, however, is that your upside is capped. Because the risk is so heavily insulated by those corporate guarantees, you purchase these properties at a premium.
So lower yields.
Right. The yields are steady, but they are relatively low. If you want aggressive growth and higher yields, you have to step away from the corporate fortresses and embrace a little bit of complexity.
Which brings us to the second tier of the EBG newsletter. Because if the single-tenant properties are the ultra-safe bonds of real estate, these multi-tenant strip centers are the growth-focused index funds.
That's a perfect analogy.
They rely almost entirely on local demographics and traffic flow.
Yeah, here, you're no longer buying corporate credit. You are buying demographic gravity.
Okay, let's look at how EBG presents these demographic gold mines. They highlight a 10,800 square foot retail center in Rockwall, Texas. It's 100% leased.
That's always a good sign.
Definitely. The tenant mix includes Amaya Tacos, Lone Star Vapor, Rockwall Phone Repair, and a Kumon Learning Center.
Yeah.
But the metric EBG screams at the reader like, complete with exclamation points, is the traffic. 116,135 vehicles per day.
Which is massive.
Mm.
In the commercial sector, VPD vehicles per day is the top of funnel metric for any retail business.
Right.
A multi-tenant center operates on a capture rate. If you have 116,000 cars driving past that Kumon center every single day, the tenant only needs to capture a fraction of 1% of that visual traffic to sustain a highly profitable business.
Wow.
Yeah, so the landlord's entire value proposition is providing those tenants access to that massive river of eyeballs.
So what does this all mean when you move up into the higher price brackets? Like EBG lists a retail strip center in Mansfield in the $2 to $5 million range. It's just under 10,000 square feet, sitting on Highway 287. And the tenants are very community-focused, right? The Play Street Museum,
Yeah.
a Pulse Fitness Studio, and a driving academy. But the detail EBG really emphasizes is that it sits directly across from a top-performing HEB grocery store in an area where the average household income tops $130,000.
Ah, and that brings us back to the concept of shadow anchor.
Shadow anchoring.
Yeah. So a traditional retail anchor is the massive big box store physically attached to your building that draws the crowd.
Like a Target or a Walmart.
Exactly. But shadow anchoring is owning the smaller property adjacent to a massive economic engine. And HEB is a cultural phenomenon in Texas.
Oh, totally. People love their HEB.
They do. And HEB spends millions on market research to pick their locations, and they spend millions more marketing to draw daily shoppers. The Mansfield Strip Center acts as a remora fish riding alongside a whale.
I love that image.
Yeah, the fitness studio and the driving academy feed entirely off the gravitational pull of the grocery store's parking lot.
That sounds incredibly lucrative, but I have to push back a little here.
Go for it.
Managing a single corporate lease with Outback Steakhouse seems effortless. But managing a vape shop, a taco place, a pediatric dentist, and a phone repair store all under one roof?
That's a lot.
Doesn't that introduce a massive operational headache? I mean, you're dealing with 4 or 5 different business owners, different lease expirations, and, a much higher chance that one of those local businesses just goes under.
You're identifying the exact reason these properties offer higher yields. You are being compensated for that operational friction.
Okay.
But look at the risk distribution. If you own the Jack in the Box in Alvin and they decide not to renew their lease after 15 years, your revenue instantly drops to 0.
Oh, true.
And you are left holding a building that looks exactly like a Jack in the Box, which is very hard to lease to anyone else.
Right. It's just a completely vacant building with a very specific drive-through.
Exactly. But with the Rockwall Center, if the phone repair shop goes out of business, you still have the taco shop, the vape shop, and the Kumon Center paying their rent.
So you're not totally wiped out.
Right. Your cash flow takes a minor hit while you fill the vacancy, but the mortgage still gets paid. You're blending your risk across multiple tenant profiles.
And the demographics dictate that tenant mix. Like in the $5 to $10 million tier, EBG highlights a brand new 2025 construction retail center in McKinney.
Okay, new build.
Yeah, nearly 13,000 square feet. The tenants are pretty elevated. Mindful Pediatric Dentistry, Jet's Pizza, Keds, and an eye-level learning center. And it sits directly at the entrance of a 1,100-acre master-planned community.
Wow.
And the household incomes here are listed between $150,000 and $170,000.
The tenant mix there is highly deliberate. I mean, when you place a pediatric dentist in an upscale learning center at the entrance of a massive, affluent residential development, You're capturing a captive audience.
Yeah, they drive past it every day.
Every single day.
Yeah.
Those families have high disposable income, and they value convenience above all else. The developer of that McKinney Center isn't just selling retail space. They are selling frictionless access to specific high net worth wallets.
It's really fascinating. It's also interesting how you can kind of blend the two strategies.
Oh, for sure.
EBG lists a retail center in Fort Worth, sitting on a hard corner, seeing 42,000 vehicles a day. But the two tenants are a Chase Bank and a Starbucks. Both corporate tenants, both just extended their leases.
That's rare.
So you get the multi-tenant risk distribution, but with the corporate guarantees of the single-tenant strategy.
That Fort Worth property is basically the holy grail for a certain class of institutional investor. I mean, you have credit-grade tenants, high traffic metrics, and staggered lease terms.
Sorry?
It commands a premium price because the perceived risk approaches zero.
Okay, here's where it gets really interesting, though. We've mapped out the safe corporate bonds. We've mapped out the demographic index funds. The final tier in the EBG newsletter completely abandons those metrics.
The wild cards.
Exactly. These are the spaces that require an investor to really roll up their sleeves and apply some serious vision.
The opportunistic tier. This is honestly where the highest returns are generated, entirely because the assets are raw, unoptimized, or just misunderstood by the broader market.
Yeah, and the vocabulary in this section of the newsletter completely changes. EBG features an exclusive listing for 2 industrial flex spaces in Roanoke, Texas.
Okay.
One is about 4,900 square feet. The other is almost 17,000 square feet. But the selling points aren't corporate guarantees or household incomes. The highlighted text reads, outside city limits, no zoning restrictions, flexible multi-building layouts, and fenced yards.
To understand the value there, you really have to define what flex space is. It's typically a hybrid building featuring a small office storefront in the front and a large roll-up warehouse space in the back.
Okay.
It is the absolute lifeblood of small to medium enterprises. Think plumbing contractors, HVAC companies, e-commerce distributors, specialty manufacturers.
But why emphasize no zoning restrictions and outside city limits?
Yeah.
Because to me, that sounds like a negative. Usually you want to be right in the middle of the city infrastructure.
For retail, yes. For industrial flex space, municipal zoning is often the biggest hurdle to profitability.
Oh, really?
Yeah. If a logistics company needs to park 10 commercial box trucks overnight, or a contractor needs to store raw materials in a fenced yard, city zoning boards will often bog them down in months of aesthetic reviews, noise ordinances, and use case restrictions.
What a nightmare.
It is. So being outside the city limits with zero zoning is the commercial equivalent of a blank canvas. It offers operational speed. A business can sign the lease on Monday and start dispatching trucks on Tuesday without asking a municipal board for permission.
Wow, okay. And the EBG newsletter specifically notes these properties have short-term leases in place, offering a, quote, value add or owner-user opportunity.
See, a standard investor will look at short-term leases as a massive risk because the tenants might leave soon.
Right.
But a value-add investor looks at short-term leases and sees an immediate opportunity to clear out underpaying tenants and sign new leases at a much higher current market rate.
Oh, that's smart.
Or an owner, user like a growing roofing company, can buy the property, let the short leases expire, and move their own operations into the space, effectively paying rent to themselves.
Okay, let's talk about a detail that completely threw me off.
Okay, what is it?
Over in McKinney, EBG has a listing for a medical and office space. It's a 2,900 square foot building currently operating as a gym, and it combines 2 units. But the newsletter literally shouts that it is selling well below county assessed value. And it highlights owner financing available. Now wait, if a property is selling below its assessed value and the seller has to act as the bank to get someone to buy it, isn't that a giant red flag?
It feels like it, doesn't it?
Yeah, it feels like catching a falling knife.
It is entirely counterintuitive if you are using residential real estate logic. But in commercial real estate, county-assessed values are notoriously disconnected from market realities. Oh yeah. Counties use mass appraisal models that lag behind the actual market by years. A property might be assessed artificially high based on some old formula, but the more crucial mechanism here is the owner financing.
How does that actually work in practice? Like, why would the seller take on that risk?
Imagine the macroeconomic environment is really tight. Bank interest rates are high, And commercial lenders are demanding 30 or 40% down payments with grueling underwriting processes that literally take months.
Which is pretty common right now.
Exactly. A seller might need immediate liquidity for another project, or perhaps they want to avoid a massive capital gains tax hit by structuring an installment sale. By offering owner financing, the seller bypasses the bank entirely.
Oh, so the buyer just pays the seller the mortgage every month.
Correct. The seller becomes the lender. They might accept a lower purchase price, but they can negotiate a higher interest rate on the note, generating passive income without the headache of managing the physical gym.
That's a win-win.
It is. For the buyer, it's a phenomenal tool. It allows an entrepreneur with a solid business plan, but perhaps a complicated financial background that a traditional bank would reject, to acquire the asset quickly. It's basically financial engineering at the local level.
That makes total sense. It isn't a distressed asset to avoid. It's a financial puzzle waiting for someone who knows how to bypass the traditional banking bottlenecks.
Precisely.
And EBG has two more wildcards that rely purely on vision. There's a 2,500 square foot retail storefront in Howe, Texas, an old downtown corner location that was recently renovated. It requires someone to envision the revitalization of a historic main street.
A classic play on urban sprawl. As the major metro areas become way too expensive, historic downtowns and peripheral cities become incredibly attractive to boutique retailers and local food concepts.
And finally, the ultimate blank canvas, a massive 37.8-acre plot of residential land in Cedar Hill. It's listed as a CHISD asset sale. That's the Cedar Hill Independent School District, and it is operating as a sealed bid opportunity.
Valuing raw land through a sealed bid is the ultimate test of market knowledge. I mean, there is no Starbucks lease to analyze.
Right. No corporate guarantees?
There's no 116,000 VPD traffic count. You are submitting your absolute best financial offer blindly without knowing what any competing developer is bidding.
That's intense.
It is. You're modeling out the cost of laying sewer lines, paving roads, and building homes 5 years into the future, and you're betting millions of dollars on your math.
It is astonishing how much complexity is packed into a single weekly email from Joseph Gosselin. I mean, when you first glance at the EBG newsletter, it just looks like a catalog of buildings with price tags attached.
But it's so much more.
It really is. When you apply the frameworks we discussed today, it transforms into a masterclass on capital flow.
It illustrates the full spectrum of risk, reward, and operational intensity available in the Texas market.
Yeah, you start at the baseline with the ultra-safe set-and-forget-it strategy. You leverage the corporate credit of Sherwin-Williams and Outback Steakhouse so you never have to worry about replacing a broken window.
Right.
And then from there, you scale up the risk to capture demographic gold mines. You buy the multi-tenant retail centers in Rockwall and Mansfield, accepting the friction of managing a vape shop and a learning center, specifically to capture the shadow anchoring effect of an HEB.
And tap into those $170,000 household incomes.
Exactly. And finally, you venture into the opportunistic plays, the unzoned industrial lots in Roanoke offering speed to market, and the below-assessed value offices in McKinney that require creative owner financing structures to unlock their true yield.
It just shows that the optimal strategy entirely depends on your personal cost of capital, your risk tolerance, and your operational capacity.
It really leaves you with something profound to ponder regarding the future of how we assign value.
How do you mean?
Well, when you analyze every single EBG listing today, the entire valuation model is predicated on physical proximity.
Very true.
You pay a premium for the privilege of sitting next to a grocery store. You pay millions to place a pediatric dentist at the physical entrance of a 1,100-acre housing development. You buy the corner lot specifically to intercept the 116,000 vehicles driving past it. Physical geography is the ultimate currency.
The physical path of the consumer dictates the capitalization rate of the asset.
But as more of our daily infrastructure, our work, our entertainment, and a massive portion of our shopping migrates into digital ecosystems, you have to wonder about the long-term decoupling of value from those physical landmarks.
It's a huge question for the industry.
Right. Will a commercial building eventually become less reliant on the specific physical path of the cars driving past it and more dependent on its ability to serve as a decentralized hub for localized delivery or experiential retail? Like, what does the exact digital equivalent of 116,000 vehicles per day look like for the brick-and-mortar businesses of the next decade?
Understanding the conversion rate of digital traffic into physical footfalls is absolutely going to redefine commercial appraisals over the next 20 years.
It's something to keep an eye on. So the next time you're stuck in traffic, Don't just stare at the strip mall or the standalone drive-through. Look at the corporate guarantees, the shadow anchors, and the unzoned flex spaces.
They aren't just background scenery.
No, they are the physical manifestation of highly calculated economic strategies operating right there in plain sight. Thank you for joining us on this deep dive.